Howdy, everybody. Welcome to Liberty Call. Today is Friday, May 30th, 2025. Hope you're having a fantastical day out there in the interwebs. It's turning into a nice day here in Colorado, although I do see some clouds, but the sun is out and it is beautiful outside. So anyways, hope you're having a great day and leading into the weekend. So markets traded water to close out the month as U.S.-China tensions flared again. Trump accused Beijing of breaking a critical mineral deal, while a federal court handed him back most of his tariffs. Meanwhile, PCE inflation cooled, keeping Fed watchers calm. NVIDIA slid despite strong earnings. Dell impressed with AI demand, and oil dipped on OPEC Plus whispers. May ended with a bang. June's already loading the fireworks. So before we break all the news down for the last business day of the month, I need some help from you. Give me some thumbs up, a like, share, subscribe, and follow, and press that notification bell. All righty, well, let's hop into today's markets. Dow Jones finished the day up 0.13%, 54 points, closed at 42,270. S&P 500 down 0.49 points, closed at 5911. NASDAQ down 0.32%, 62 points, closed at 19,113. The VIX was also down today, 3.13%. It's at 1858. Canada down 0.14, Brazil down 1% even, and Mexico down 1.32. Jumping over to Europe, Germany up 0.31%, the UK up 0.64%, France down 0.36%, Netherlands down 0.14%, Spain up 0.25%, Italy up 0.26%, Switzerland up 0.27%, and Portugal up 0.17%. Russian exchanges both green again today. The MOEX up 0.62%, RTSI up 0.46%, and the overnight markets, the Nikkei in Japan was down 1.22%. Australia up 0.3%, New Zealand down 0.61%. In China, the Shanghai down 0.47%, Shenzhen Component down 0.85%, China A50 down 0.44%, DJ Shanghai down 0.54%, Hang Seng down 1.2%, and the Taiwan weighted when it closed on the 29th was down 0.05%. All righty, let's jump to our indexes for the week. So let's starting out with the Dow Jones. We had a short week, only 5 trading days. It is going to finish the week up 1.5%. The S&P 500 is going to finish up about 1.74%. The NASDAQ is going to finish up about 1.92%. The Dow Transports up about 0.98%. And the Dow Utilities finish in the green by 0.48. So it looks like green across the board for the week. Certainly, nothing fantastic, but certainly not too terrible. So, all right, let's get that off the screen, and we'll get to our economic data that came out during the week. Starting out with initial jobless claims, came in at 240,000, above the 229 forecast. Previous number was 226. Continuing claims came in at 1.919 million. Forecast was 1.89, and the previous number was 1.893. So both of those have ticked up a little bit. U.S. durable goods orders month over month contracted at 6.3%. The forecast was a contraction of 7.6, and the previous number was a growth of 7.6. House price index year over year came in for this month at up 3.7%. Previous number was 3.9, so down a little bit there. And the house price index month over month contracted by 0.1%. The consumer confidence index came in at 98. Forecast was 87.1. Previous number was 85.7. And we got our second reading of the GDP for Q1. It was revised up to negative 0.2 from negative 0.3 was the forecast. And obviously, last quarter's number was 2.4% for the end of last year. Why am I stuck? There we go. All right. U.S. Federal Reserve balance sheet came in at 6.673 trillion. Previous number was 6.689. So it did tick down just a smidge, even though the Fed has been increasing the money supply again. That's not a great thing. Pending home sales came in at the sales index came in at 71.3. Previous number was 76.1. And the PCE price index year over year grew at 2.1%. That's the personal consumption and expenditures index. Came in at 2.1. Forecast was 2.2. Previous number 2.3. And the PCE price index grew by 0.1. forecast was 0.1. So those are, wait a minute, PCE price index year over year. Okay, yeah, it's the monthly. And the goods trade balance, basically the how much our trade deficit came in at a negative 87.62 billion, much better than the forecast of negative 142.8 and the previous number of negative 162.25 billion. So it certainly jumped back a lot, probably because a lot of companies that were bringing in goods from overseas pretty much stopped. They front loaded before the tariffs. And last but not least, the Michigan consumer sentiment came in at 52.2. Forecast was 50.8. Previous number was 52.2. All right. So that is all of the data for the week. All right. Let's get our market recap. SP 500 fall as chips dip on fears of further U.S. sanctions on Chinese tech firms. The SP 500 closed lower on Friday, weighed down by renewed fears of an expanded U.S. crackdown on Chinese tech firms. NVIDIA led the tech sector's slide, dropping more than 3% after reports emerged that the Trump administration plans to broaden chip export restrictions to include subsidiaries of already sanctioned Chinese firms. This comes after NVIDIA flagged an $8 billion revenue hit tied to existing Chinese-related export bans. Despite Friday's losses, major U.S. indexes are set to post strong gains for May, rebounding from April's tariff-driven sell-off. However, escalating trade tensions between the U.S. and China are dampening sentiment. President Trump accused China of violating a recent trade agreement, while Treasury Secretary Scott Bessent suggested direct talks between Trump and Xi Jinping may be necessary to revive negotiations. Markets were also rattled by a court decision reinstating Trump's tariffs, reversing an earlier trade court ruling that had ordered their removal. This reversal delays potential tariff relief and introduces further uncertainty as the next hearing is set for June 5th. On the economic front, the April PCE index, closely tracked by the Fed, showed inflation easing, with core PCE falling to 2.5% year over year, potentially opening the door to future rate cuts. Again, everyone wants lower interest rates. However, first quarter GDP data showed a 0.2% contraction, hinting at damage from erratic trade policy. Corporate earnings were mixed. Gap warned tariffs could cost it up to $150 million, despite strong results. Dell raised guidance, while American Eagle posted a surprise loss. Ulta surged after booking its outlook. Overall, markets are balancing softening inflation with persistent trade turmoil, uncertain Fed policy, and an ongoing corporate struggles with tariff costs, all under the shadow of potential U.S.-China confrontation that could reshape global trade and tech landscapes. Well, is what it is. So, all righty, you got a data report here, the April personal income and consumption report from First Trust. Mr. Andrew Opdyke put this together, so let's read through his report here. Consumer spending power surged in early 2025, with personal income rising 0.8% in April, continuing a string of strong monthly gains. However, much of this increase is being fueled by government transfer payments rather than organic economic growth. April's boost was largely driven by payments related to the Social Security Fairness Act, benefiting public sector workers. Private sector wages also rose a solid 0.5% for the month and are up 4.5% over the past year, modestly outpacing inflation. In contrast, public sector pay jumped 5.3% and government benefits rose 11.1% year over year, raising concerns about sustainability of such spending. I'd fire them all if it was up to me. I mean, federal employees are basically worthless. Personal consumption rose just 0.2% in April, with service spending up 0.4%, led by housing, healthcare, and food services, while goods spending declined 0.1%, mostly from weak demand across non-energy items. Inflation appears to be cooling. The PCE price index rose only 0.1% in April and 2.1% year over year, matching the lowest reading since early 2021. Core PCE inflation also rose 0.1% for March, or for the month, and 2.5% annually. Despite softening inflation, the Fed is expected to hold rates steady in June, watching for inflationary risks from tariffs and political uncertainty. However, rate cuts could resume later this year. Meanwhile, pending home sales dropped 6.3% in April, hinting at stagnating existing home sales in May. On a positive note, April's advanced trade report showed a sharp drop in the trade deficit, which could provide a boost to Q2 GDP and help offset the slight 0.2% contraction in Q1. Again, the Q1 number being in the red doesn't really give me a whole lot of worry right now, simply because, it's explainable. All these companies were, bringing in goods ahead of the tariffs, hoping to avoid that surcharge. And now that, they've kind of front loaded their inventory for a few months, we're going to see a dramatic change, which we already saw this month. All right. One more article to cover from Zero Hedge. Peter Schiff, traders are selling America. And this comes from his latest podcast. So let's read through it. In his latest podcast, Mr. Schiff dissects a rough week for American financial markets, highlighting broad-based sell-offs and a major breakout in gold, which surged over 5%. He criticizes the ongoing structural flaws in U.S. fiscal and monetary policy, asserting that treasuries, once viewed as safe havens, have now become high-risk assets due to the exploding federal debt and weakening dollar. Schiff warns that holding U.S. government bonds offers no path to profit, only guarantees losses, whether through default or inflation-driven devaluation. Schiff points out that the markets are beginning to reflect what he predicted years ago, that Trump's policies, particularly protectionist tariffs, would lead to sell America, and that's in quotes, sentiment. These tariffs, he argues, are hurting American consumers directly by raising prices at stores like Walmart, contrary to political narratives suggesting that foreign exporters bear the cost. The weakening dollar only worsens the situation, undercutting any offsetting benefit from supposed currency strength. He criticizes both political parties for accelerating the country's debt spiral, regardless of who's in office. The U.S. remains on a crash course towards a fiscal and currency crisis, only now moving faster. According to Schiff, gold remains the only true safe haven as both stocks and bonds lose investor confidence amid rising geopolitical and economic instability. Ultimately, Schiff's core message is that the current policy trajectory ensures continued financial deterioration. Investors must recognize that the old rules no longer apply. U.S. treasuries are not safe. Inflation is not under control, and gold is the only asset rising in the chaos. Well, certainly his opinion. I don't disagree with a lot of it, but he's kind of on track with a lot of stuff here. He's a bit of a gold, everything gold is solves all of his problems. I'm a little more, objective when it comes to that sort of stuff. All righty. Well, that is everything that I wanted to cover for today. So I hope you enjoyed my ramblings. If you need to get in touch with me, where do you want to go? DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a ring. I would be glad to help. All right. Well, I hope everyone out there has a terrifical weekend. I'm going to watch some baseball. Astros blew it last night. They played like crap. But it was tied up until the 7th, and then, Tampa Bay just unloaded on them. So anyways, well, I hope everyone out there has a wonderful weekend, and I'll talk to everyone again next time. Adios.